Hello, welcome, good evening. Thank you for joining us for our 2025 Market Forecast presentation. I'm Marcia Zappa, Director of Marketing and Business Development at Affiance Financial, and I'm pleased to be joining tonight's presentation as moderator. Tonight's presenter is Marc Usem, our Chief Investment Officer. Marc brings more than 30 years of investment experience, including close to a decade of helping to shape the investment strategy at Affiance Financial. Marc is a husband, a father to 5 grown and flown kids, and one 4-month-old mini Bernie doodle. Thank you for taking the time to put this presentation together for us again this year, Marc.
Thanks, Marcia. Thank you for being here and helping with this, of course, and thank you to everybody for joining us tonight.
Absolutely. I do have a few housekeeping items that I'd like to go over before we begin. First of all, we have closed captioning turned on for tonight's presentation. If you would prefer to disable that, that can be found in the Zoom settings at the bottom of your screen. We are going to share a PDF of tonight's presentation in the chat if you would like to download a copy. We are not going to be having a live Q&A during tonight's presentation. Thank you to everyone who asked a question when registering for this event. We have done our best to take those questions and incorporate as many of them as possible into the presentation tonight. Additionally, if you do have a question that pops up during the presentation, please feel free to put that into the chat. Our team will collect those questions from the chat, and your advisor will reach out to you this week in order to discuss your specific questions. We are going to be sending a recording of this presentation out. It will be on our blog, and we will be emailing it later this week. And finally, we do have a little survey prepared for the end of the presentation. It's a very brief survey, but if you do have a few extra moments when the presentation is over, please do take the time to share your feedback with us. We take that really seriously and work hard to improve this presentation every year. So we greatly appreciate if you take the time to share your thoughts with us. And finally, before we get started, I have an important disclosure to share with everyone. Please remember there can be no assurance that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and/or applicable laws, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as the receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. And with that, take it away, Marc.
Thank you, Marcia. Thank you for that introduction and those important notes. As we jump in here, I guess I'd like to just introduce our investment team. Myself, Tanner Steele, and Nico Panizidis work closely together to form the investment processes and strategies. And we also have an investment committee. Our investment committee meets once a month and consists of me, Tanner, and Nico, as well as our firm founders, Steve Lear and Andy Fishman, our firm president, Eric Unger, and Brendan Halloran, who's one of our partners and advisors that helps round out our investment committee. We certainly appreciate the opportunity to serve our clients, and this is the committee committed to continuing to refine our investment processes and strategies. With that, we'll jump into our agenda for tonight. So we're going to cover 2024. We're going to take a look back and see what happened. We're going to look ahead to 2025 and take what we call an earnings-based approach. We'll look at monetary policy in the Federal Reserve, fiscal policy in Washington, D.C., and then our outlook for 2025.
All right, Marc, I'm dying to know, how were your predictions last year at the beginning of 2024?
Well, you want to know how we did in 2024. Okay.
That's right.
Okay. Well, let's look. First was we said there's going to be a soft landing in 2024, meaning we're not going to have a recession, even though the Fed had raised rates so much in 2022. And we think we have a soft landing this year. And Fed cuts probably priced in to some extent. I think that was pretty true as well. Current PE valuations reasonable. Early stages of AI realization, I think those things also rung true as markets continued to advance last year, and certainly AI took center stage. We said earnings are expected to grow in 2024, albeit a bit more slowly against higher rates. Again, we did see earnings growth slow a bit in 2024, and the Fed started actually cutting. Falling inflation. Yep. Another plus there, we saw inflation fall not as significantly as in 2023, but rates fell about 0.5% in 2024. Finally, our market prediction, well, we said the S&P 500 would grow about 14% to about 54.28. That was just based on our math. Actual was 58.81. Market was up about 25%.
Wow, Mark, you were really close on all of your predictions, aside from being a little too conservative when it came to the stock market.
Well, that's just what the numbers sort of gave us, and we like to underpromise and overdeliver, so I guess that worked out. Well, let's take a look at 2024 more specifically with a couple of graphs here. The top in the blue is the S&P 500 index, which rose rapidly throughout the year. A couple of little hiccups here in the early spring and then middle of the year, but ended up 25% for the year. We saw international stocks rally not quite as strongly through most of the year, but then in the fall started to trail off, only up 5.2 for the year. Positive, but not close to US markets, of course. And then bonds kind of plodded along, gaining toward the end of the year, up 1.3%. So actually earning a little less than their coupon rates, which were around 3%, although still positive. So bonds really struggled amid volatile interest rates last year. If we look at the last 2 years, and we really want to do this because they are so exceptional, 2023, S&P 500 is up 26.3%. Then last year, up 25% for a 58% 2-year return. Really tremendous. And bonds up 5.5% in 2023, and then 1.3% last year. Still up 7% is not bad, and bonds are supposed to be kind of that ballast to the portfolio, but generating positive returns nonetheless. So really incredible 2-year run here.
That is exceptional when you see it back to back like
Yeah.
that, Mark. What is it that's driving all that growth?
Well, it actually didn't change last year. It was another year of the Magnificent Seven. This is one of my favorite graphics from, I love Westerns, and I said, well, this is a perfect fit. We have to show this. They fought like 700. Well, it was more like 500, the S&P 500, right? Nonetheless, the Magnificent Seven was tops again in 2024. The top 7 accounted for half the gains in the S&P 500, and AI was really that driving force. The top 7 grew to a record 33% of the S&P 500 market cap. And you can see in the graph, that's a record high. If you go back to the dot-com bubble in 2000, it was only 20%. So the last several years have seen the top stocks really garner more and more share of the total market cap. If we don't remember who they are, we have this table on the right. Apple, Nvidia, Microsoft, Alphabet, Amazon, Meta, and Tesla, making up over 33% of the market. And on a global basis, if you look at the All Cap World Index, over 2,600 stocks around the world, over 21% of the total global market cap. So really, really concentrated in these top names.
So based on that list, I assume that the tech sector must have performed really well last year.
Well, the tech sector did well last year, but it wasn't the top sector. And part of that has to do with definition. So I think a lot of people think, well, the Mag 7 those are all tech names, right?
Right.
Well, no, that's not how they've been categorized. So top sector was communication services, up 36%. Well, Meta and Alphabet are in the communication sector. Consumer discretionary, third best sector after S&P, has Amazon and Tesla in it. Okay, so that was helping drive consumer discretionary. Obviously, those cap weights driving much of that. And then technology still did well, although it was only the fifth best sector, but it had Apple, NVIDIA, and Microsoft in it. So those top 7 names are distributed among different industries. I think it's also interesting on the left side of the graph here, this style box. So large, mid, and small cap stocks on the y-axis here, value, blend, and growth across the top. And we can see the large growth continued to outperform all the other sizes and styles. I think small cap value being the worst performer, huge differential there, the widest it's been in a really long time. So those large cap growth stocks, those Mag 7 are really still generating most of the market gains in the last year. So that was last year. Let's take a look ahead. We're going to take an earnings-based approach. So Marcia, you ready for a little finance 101?
Oh boy, let's go for it, Mark.
Okay. So we're going to talk about earnings and stock prices, the E, the P, and the PE ratio, okay?
Okay.
So it's really simple. The price of a stock or index is really a function of 2 things, the earnings per share that it's going to generate or generates, and the multiple of earnings per share that investors are willing to pay. So for every dollar of earnings, what am I willing to pay for that? And that gives me the value of the stock or index. So one example, in 2024, the S&P earnings estimate is $233 a share. Investors are willing to pay 25 times that. So 25 times 233 is 58.25, which was the price at the end of the year, actually. Now you can back into it a little differently too. You can say, hey, I know the value of the S&P 500. It's 58.25. I think earnings, or I know earnings are 233 a share. I can just divide those and say, oh, I know people are paying 25 times for those earnings to get to that index price. So this kind of simple concept, I think, helps us walk through some of the next slides. Sound good?
Okay. I'm with you so far.
Okay. Well, let's talk about earnings and multiple factors. Again, we said these are the things that sort of determine the index and stock levels, right? But there are many factors that influence earnings and the multiple people are willing to pay for those earnings. And these are 6 of those factors. Expected earnings growth rate. How fast are earnings actually growing, not just the number, right? Operating profits and margins, interest rates, monetary policy expectations, fiscal policy expectations, and investor sentiment. These factors all have varying levels of influence that can significantly differ over time, but nonetheless, all influence earnings and the multiple people are willing to pay. So if we took a look at last year and this year, last year, S&P 500 earnings growth rate was about 8%. And I think back at the beginning, we said we thought maybe slower growth. So 8% is good, but not tremendous. Although for 2025, earnings are supposed to accelerate to a 16% growth rate from 2024. So that would be a positive, right? Earnings are actually growing faster. Now, if we do the math and we say, oh, it's going to go to $271 a share from 233, if we take today's same earnings multiple of 25, sorry, and we say 25 times 271 is 67.75 in 1 year, or about 16% higher.
Well, that would be a great year.
Would be a good year, and hopefully we'll see that. Next factor, operating profits and margins. So S&P 500 margins are about 10.5%, near the highest normal margin rates in history. So clearly COVID distorted rates a bit, but then margins have sort of been on this trend line for quite a while here. So higher margins generally leads to higher multiples.
What keeps driving this normal margin rate higher?
Well, there have been 2 major things that we found driving margin rates higher over the last decade or so. And the 2 biggest are actually interest rates and tax rates. So lower interest rates and lower tax rates have really been primary drivers of higher earnings, of higher margins, actually, in the last decade. Let's look at interest rates. We know interest rates affect bonds, but they also affect stocks. Interest rates fell almost for 40 plus years from the 1980s all the way till the very bottom in 2020, and then started to rise again. The orange part here is 10-year treasury rates in 2022. When the Fed started raising rates to help dampen inflation, they raised rates rapidly. That rapid increase in rates impacted both stocks and bonds, ending up in 2022 being a tough year. Interest rates have kind of stabilized in this 4 to 5% range now. They're about 478, actually a little lower, 458 today. We think they're just going to be more range bound going forward. We don't see a significant increase or decrease in rates. And if they stay in this range, that sort of helps stabilize stock valuations going forward. So let's look at monetary policy and the Federal Reserve. Two major camps for monetary policy. Is the Fed dovish or hawkish? If they're dovish, that means loose or accommodative monetary policy, lower Fed funds rates, increased money supply, maybe lower discount rate. We think we're in that camp today. That's a plus.
Okay.
No, the opposite could be they're hawkish, tighter restrictive monetary policy, higher Fed funds rates, restricted or reduced money supply, higher discount rate, and that's what we saw back in 2022, actually. So positive on monetary policy today. Next is fiscal policy in Washington, D.C. Very similar, stimulus or austerity. Is there accommodative fiscal policy with higher government spending, lower taxes, and deregulation? Yeah, we kind of think that's what we're looking at today. Or is it austerity with tighter restrictive fiscal policy, lower government spending, higher taxes, and more regulation? Probably not. Then there's some other factors, higher tariffs and immigration that don't fit neatly into a bucket, but nonetheless, generally we think those are a negative from an economic perspective today. So kind of a mixed picture on fiscal policy in Washington, D.C. Finally, we have investor sentiment, psychology. How do people feel about investing in the stock market? Well, again, a couple major theories here. Animal spirits, popularized by famous economist John Maynard Keynes, means how do people feel about investing? How are sort of that herd mentality? People are in a good mood or a bad mood. And so these things that you can't really put your finger on, you can't quantify so much, but there's generally a positive spirit around investing. Burton Malkiel, famous author of Random Walk Down Wall Street, calls it castles in the air. Same idea. We can't really put our finger on exactly what it is, but it's good. Okay. Some other common themes are markets climb a wall of worry. Markets keep going up and people worry, 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 worry. Of course, one day you might be right, but nonetheless, they climb a wall of worry. That goes to FOMO, fear of missing out. If markets are doing well, hey, people want to get in on this and keep the market going. Or Tina, there is no alternative. Again, when markets are doing well, people say, well, there's not a better place to invest. I have to be here, right? So all of it's kind of reflection of current trends and are markets overall rising or falling?
Yeah, well, this idea is pretty easy to understand. After that graph you showed us of 2+ years of or 2 straight years of 25+% growth, I can't imagine anyone wanting to miss out on that.
That's is definitely a driver. It's definitely a driver. I think, and we can, say for sure right now, all of these things are pretty much true, right?
Mhm.
Psychology has been pretty positive. So let's take it out a step here. Let's look at all the factors and take score. So expected earnings growth rate, positive. We expect acceleration in 2025. Operating profits and margins are high. We expect that to remain the same. Interest rates look stable after going up quite a bit in 2022 and possibly even a little lower going forward. Monetary policy looks positive. Fiscal policy is mixed, and investor sentiment overall is positive. So aside from the mixed fiscal policy picture, all the factors are really positive. So I would say, overall influences on earnings and multiples are good. But markets don't go up in a straight line. We know that. We expect there to be some volatility going forward. And so stock market declines are part of investing. We should expect that. A 5% oops, I don't know what happened. A 5% decline about once every year or 101 days. The last occurrence, just August of last year, we were down 5%. 10% or more about once every 2.5 years. Average length 234 days. We saw that in fall of 2023, October, markets were down 10%. 15% or more about once every 5 years, 345 days length. Last was May of 22. Now we know 2022 was a bad year, and that 20% decline once about every 6 years. These things are often correlated. The 15 and 20% often go together. We saw that in 2022 as well, with markets continuing down after that 15%. So each downturn has been followed by recovery, and over time, a new market high.
So this is our 2025 market forecast presentation. Some of these years, October 23, starting to feel a little far away. Are we due for a correction?
Well, I think that's the question on a lot of people's minds. And so we look back at the data, and we looked at the S&P 500 and returns after 2 years, consecutive years of 20% plus returns. And what do we find? Well, back in the 20s and 30s, there were some significant down years after a couple up years, but then it gets more mixed. And 44, 52, 56, we saw positive returns, nicely positive returns after two sequential years of 20% plus returns. 77, a slight down year, and then 84 positive. The mid 90s, one of the longest stretches of positive returns in history, 95, 6, 7, 8, 9, all positive, up more than 20% in a row, really tremendous. And then 2000, a down year at sort of the end of that stretch. So the data would say, yeah, if things remain positive, if the underlying fundamentals remain strong, we could certainly have another up year in 2025, just based on history. So let's take a look at valuation for a second, using that same price earnings concept we talked about a few minutes ago. So you can see through history, this goes back to 1988, but the price to earnings ratio of the S&P 500 has varied through time, meaning, hey, Mr. Investor, are you willing to pay 20 times earnings or 15 times earnings? And that changes based on those factors we discussed, right? And so we saw going into the mid 90s, this was the dot-com boom, that people were willing to pay more and more for each dollar of earnings until we got to the near 30. It has ebbed and flowed through time. We're currently at about 25 times earnings. So it's high relative to history, but not extreme from the standpoint of it's beyond prior peaks. Now, if we zoom way out, 1926 to 2023, this is the S&P 500. This blue line looks like it barely moves, right? It's just straight as an arrow. But we're using a log scale, meaning the percentage changes from the S&P to this dotted trend line are the same across time. And certainly we've seen ebbs and flows from this trend line. The roaring 20s, of course, was the biggest deviation, but then we've seen periods over, above and below the trend. So inflation plagued 70s sat below trend. .com, we saw it jump way above trend, come back. Great financial crisis. I think a lot of people would imagine, 2008 was well below this, not as much as you'd think, even though it was certainly very bad and disruptive. And then we've grown back along this trend line. So if we look at this super long trend line, we're not that far from the trend, actually. And certainly this kind of says, look, staying the course has been rewarded for nearly 100 years. Long-term return to stocks over this entire time period, 10.3% on average. Not that you're going to get that every year, but on average, over that long period of time, very nice returns to holding stocks. So some takeaways for 2025. We think the current earnings influences are overall positive. We know markets go up over time, but not in a straight line. Expect some volatility, like we saw today. Time in the market is more important than market timing. We saw that long-term chart that kind of drives that message home.
Yeah. So what you're saying, Mark, is that even though we did see all those green plus signs, all those positive indicators, it's really important for our clients to stay the course, maintain their asset allocation, and not try to reach for returns.
Exactly, Marcia. Staying the course, I think, is so critical. Markets are going to have their ebbs and flows.
Mhm.
Again, today we saw DeepSeek kind of disrupt things and, some markets sell off, but we saw a nice rotation into the value side of the market, meaning things are still, I think, overall positive, but
Right.
certainly diversification, I think, is the other lesson that's key here is remaining diversified and remaining with your plan, staying with your plan, like you said, is so critical. So let's dive down a little deeper into monetary policy and the Federal Reserve factors. So monetary policy is one of the factors that we talked about in the beginning that influence earnings and the earnings multiple. But this factor has its own set of factors that influence it, right? So monetary policy is influenced by inflation, liquidity, employment, GDP growth, and interest rate policy. And I think the big question we're trying to answer here is, will the Federal Reserve stay on course during 2025? So let's jump into the inflation question first. So we're looking at the Fed funds rate versus consumer price inflation. And we can see 2008, 2009, the great financial crisis. The red is the Fed funds rate, and the Fed dropped rates as markets came down. Inflation fell, and they kept them at zero for a really long time,
Mhm.
even though inflation kind of bounced around. We got to 2016 and the Fed started to try to normalize interest rates, bring them up further. And they did until we hit COVID. Then they started over, dropped rates back to zero when the economy shut down and inflation jumped. And we know that story. But the Fed thought this inflation was transitory and they kind of waited a while before they started to raise rates. And once they started, though, they raised rates rapidly. Inflation started to come down. And now we're in this sort of normal phase. And if you look back in time, back to the 70s, really the normal course is that the Fed funds rate sits a little bit above the inflation rate. And again, that's kind of where we are now. So I think we can say inflation and interest rates have more or less normalized.
We hear a lot about the statistic, the CPI, of course, in this presentation every year, but also in the news. But Mark, can you tell us a little bit about what that means for our clients?
Well, we broke down inflation to just look at food inflation because everybody's buying food,
Mhm.
hopefully. And I thought it'd be interesting to look at this specifically. So if we look back here, we see inflation rising for food. This is well before COVID, 2016, 17, 18. Of course, these numbers are very low, percent or two. And then we see COVID hit, inflation jump, and the giant carrot here up almost 10%. Food got expensive, right?
Yeah.
Now the inflation rate has come down back to the 2% range, but prices are high, right? Because we don't see negative inflation. We don't see prices falling. It's just not rising as fast. So let's take a look at a food basket and see what that actually means on the ground here, okay? So dozen eggs, this is a 4-year change from 2020 to 2024, up 111%.
Wow.
Big,
Mhm.
big jump in egg prices. Orange juice, 12-ounce frozen orange juice up 82%. Bread, a pound of bread up 36%. Sirloin steak up 30%. For some reason, I thought it was up more, but 30%. Milk up 26%. Chicken breast also up 26%. If you take this whole basket, not that everybody's buying them in equal shares, but nonetheless, the whole basket is up about 41%. Now, if we compare that with average hourly earnings, over that same time period, we only see earnings up about 19%. So that food inflation is really having an impact on consumers' wallets.
Yeah, seeing it laid out this way, especially that total of 41% compared to the 19% for average earnings, it's really clear why so many people are struggling.
It is. And there's different reasons for, different pieces of this inflation picture. Eggs in particular, the avian flu has wiped out, millions of chickens. And so
Mhm.
I expect egg prices probably up another 20% this year or so. But overall, food inflation is expected to grow something like only 2% this year.
Okay.
Better news, better news.
Yeah.
So let's take a look at another factor influencing the monetary system here, and that's money supply. So how much currency is in circulation? And we see that over time, it's actually pretty stable. And this big blip here in 2020 is COVID. So as the government shut down, the Fed wanted to make sure that there was enough money circulating in the system so things didn't freeze up and the transactions that were taking place went smoothly. Of course, as inflation spiked, they started to take liquidity out of the market and it actually went negative. They started to reduce the money supply. It has rebounded back and is now kind of running around that 5% long-term average. So money supply, I would say, is back to kind of normal, which would be a plus. Another factor is the unemployment rate. The unemployment rate generally looks a little bit like a sawtooth. It goes down and then we have recession, it goes up and it goes down. But we can see it's trended down, and then COVID really disrupted things. COVID disrupted everybody's numbers. But we saw this huge jump, a record jump to almost 15% 2020 as everything closed. And then it dropped back rapidly as the economy reopened. Even as far as 2022, we're back to normal levels. Still very, very good level of unemployment, around 4%, probably close to natural rate, but nonetheless, the Fed I don't think is too worried about employment, and given that they can focus on using their monetary policy to focus on inflation and stability.
So aside from that COVID spike you pointed out, unemployment has been pretty steady, at least as far back as 2018 there. And you said yourself the Fed's not too worried about it. Why do we continue to take a look at this data?
Well, it's important because it's part of the Fed's dual mandate. So their dual mandate is stable prices and full employment. And so because it's so critical to their monetary policy, that's why we look at this so carefully. If, for example, they saw the unemployment rate start to rise rapidly, they might say, oh, we better keep things loose, or economies may be slowing down, people aren't being hired as much. And so that would influence monetary policy. On the other hand, if they saw it drop rapidly, maybe down to 3% or less, they might get concerned that things are heating up too much, and they might actually have to increase interest rates to slow economy down. So this is one of those major factors that they're looking at over time. Does that make sense?
It does.
Yeah, it's an important factor for the Fed. Let's also now look at real GDP growth. So GDP growth, stable economy. It's actually the third stool of the Fed's dual mandate. There's really three things. They call it the dual mandate. I don't know why, but the third is actually stable growth. And growth has been incredibly stable actually through the last 4 years. So 2021, very strong year coming out of COVID. 2022, we saw the downturn. Now, only 1 quarter of negative GDP growth. Usually it takes 2 quarters to call it a recession. So no formal recession in 2022, even though markets reacted negatively during that period as the Fed raised rates rapidly to quell inflation. 2023, stable growth across the quarters. 2024, pretty stable growth across the quarters again. And I would say probably without really much doubt, the Fed engineered a soft landing. And, a year or so ago, a lot of people talked about this. Are we going to have a recession? Is there going to be a soft landing? What's the probability of these things? And I think that, the jury's no longer out. We do have a soft landing. I think this will be Powell's legacy. Last time this happened was really under Greenspan in the mid-90s, 1994, raising rates to quell inflation again. Started cutting in 1995. There were concerns, would there be a soft landing? And Greenspan did create a soft landing under that time frame as well. So really important for the economy to be able to, now we're going to give the Fed the benefit of the doubt. They engineered this, but I think a lot of factors went into it. Anyway, 2025 GDP growth is estimated at a little over 2%. So again, we think the economy is poised to continue to grow into the next year. So now let's take a look at the Fed rate policy. So this is information actually provided directly from the Fed, and this is called their dot plot. This is where the Fed governors think rates are going to go based on what they're seeing in the economy today. It starts as 2024, and last year we know the Fed decreased the Fed funds rate by 1% in 3 different cuts, First, quickly at 50 basis points and then 225 basis point cuts. Now we're looking at 2025, and the consensus is that the Fed will continue to cut rates by 0.5% or 50 basis points in 2025. Now, exactly when that happens isn't laid out here in time, but the expectation by the Fed is actually they'll lower rates a bit. 2026, that's getting a little further out. We can see the dispersion a little bit more, how much further rates are going to go down, but the consensus is still another 0.5% or so. And then looking out even further into 2027, maybe another cut or so. So the bias here is clear that the Fed, as of a month ago at least, still thought that they'd be lowering rates this year.
Yeah, definitely a clear trend.
So let's take stock of the Fed policy. Inflation, a negative. Why? Even though it's down at 2.9% or so, it's still not to the Fed's 2% target. So that could be a negative bias, meaning the Fed may keep rates higher for longer. Liquidity, a plus. We saw M2 back to 5% kind of annualized growth rate. Employment looks pretty good at around 4% unemployment rate. GDP growth, again, positive, and we think positive this year. And interest rate policy, also positive, meaning the Fed expects to cut rates a little bit more, at least this year. So aside from that stickier than expected inflation, Fed policy looks pretty good.
Yeah, more green plus signs here.
More green plus signs, exactly. That's what we want to see. So let's switch gears and look at fiscal policy in Washington, D.C. How will Trump and Congress impact the economy?
I am so glad to see this slide here, Mark, because I know that this was the #1 question submitted by our audience for this presentation. So I'm glad that we're going to dive into this next.
And I appreciate that. And also note that this is one of the hardest things to sort of predict and estimate the impacts, but let's try.
Okay, fair enough.
So again, in the beginning, we saw the earnings and multiple factor of fiscal policy, but this again has its own set of factors that drive fiscal policy. We'll look at taxes, tariffs, immigration, and deregulation. So first, taxes. We believe that the government, White House and Congress, will extend the 2017 Tax Cuts and Job Act, and that rates really won't change, right? We'll be in the same tax rate environment that we're in today. And this gives a little history of the corporate tax rate environment. Of course, going back all the way to the 20s, the 50s, corporate tax rates were quite high, coming down in the 80s and 90s. Finally, Tax Cuts and Job Act brought it down from 35% to 21% today. There is talk of potentially reducing this a bit more, but still, it's as low as it's been in 65 years since about 1940, looking back. If we take it to the individual side, top tax bracket is 37% today versus 39% before the cuts in 2016. So kind of at the end of the chart here, but that's kind of in the range where it's been for quite some time, probably several decades. We can see before that rates were much higher and they stepped down through the decades to the 1990s or so. So top bracket being much more reasonable today than it has been in the past.
Yeah, this graph is actually kind of astounding, Mark. I realize it's just the top bracket, but seeing that it was above 90% in the 50s and 60s is almost unbelievable by today's terms.
Yeah, it really is. You can't imagine the disincentive to give 90% of your dollar to the federal government when you're working back in 1955. But I'm glad we're not there today.
I can't imagine it was very popular.
Well, let's look at I think one of the top topics here, which is tariffs. So this is the expected impact of proposed tariffs on GDP. And the assumption here is that we're 10% universal tariff, 60% China tariff, and some expected retaliation from those countries, meaning they're probably putting tariffs on us too. We're looking at estimates from 3 different providers, Fitch, the Budget Lab, and the Tax Foundation. And in all cases, their high and low estimates are negative, somewhere around 1% or so on the high side, and maybe 0.5% or so on the low side. Averages here about 98 basis points, 57 basis points. So unequivocally negative. And I think, the reduction in GDP is not a surprise to anyone. But I think, some of the surprise related is that it might end up in some higher US inflation. We'll be paying higher prices for goods produced abroad. Although there will be some increase in the government revenue as they collect these tariffs. So GDP impact overall is expected to be negative.
Tariffs have definitely been a hot topic. We've been hearing about them for months. But how likely do you think it is that they actually go into effect?
Well, I think that's, one of the key questions is, do they go into effect and how much and when? And I think the expectation is that we will see some tariff increases because I think that's a promise that will be kept. Now, exactly how much those tariffs are, where they're applied and when is a question. They've been, put off. I think there was some expectation that day one we'd see these tariffs implemented, and that has been pushed down the road a bit. So expectation is, yes, we'll see some tariffs, but exactly where and exactly how much has yet to be seen. The other hot topic, I think, is immigration. So this is the expected impact of the immigration plan on GDP. This is a single estimate by the Brookings Foundation, and this high estimate is based on 1.3 million total removals in 2025 out of 13 million potential illegal immigrants. Okay, so in this case, the high is about half of what it was for tariffs, right? About 0.5% versus 1%. And the low, pretty small, only about 0.1%. So even though the overall expectation has some negative impact on GDP, there are other issues, right? So probably reduction in GDP could lead to some worker shortages. So as people are forced out, those jobs still have to be replaced. If they're working, that may mean hiring people and paying them more than the people that left, right? So we could see an increase of inflation. Current estimates could be as much as 0.5%. Could reduce government revenue because even though people are here legally, they are spending, right, on things, and so that could be a reduction. And then social impacts, obviously, I think overall would be negative. Now that doesn't factor into GDP specifically, but certainly an issue, right?
Right.
Finally, deregulation. So this is the hardest to quantify. We don't have great numbers on this, but overall, our expectation is that it stimulates economic activity. It can increase competition and innovation and market growth. It does reduce operation complexity. You don't have as many hoops to jump through to get things done, and reduce costs of compliance kind of by definition. So overall, would be expected to be positive for GDP growth. But deregulation has risks associated with it too. It could increase the monopoly power in large companies. And we saw the largest companies are the largest they've ever been in history.
Right.
So this could be a place that actually increases risks. It may not protect consumers' best interests at the expense of consumers and sort of obviously benefiting corporations, reduces industry transparency and insight, and could increase the risk of corporate fraud. Net, we take the pieces here and we look at taxes. A positive. Taxes aren't going to go higher. Probably think Tax Cuts and Job Act gets extended here. Tariffs, a negative. We saw the numbers. Immigration, a smaller negative, but nonetheless a negative. And then deregulation, a positive, but very hard to quantify. So a mixed picture, I would say, on an economic impact of Washington and fiscal policy.
All right, Mark. We've covered a lot tonight with that earnings-based approach to the stock market, monetary policy, and now this mixed picture for fiscal policy. Can you bring that all together for our audience?
Marcia, we can. We have a scorecard.
Perfect.
So outlook for 2025, let's just run down where we were. So earnings and multiple factors are positive, right? Across the board, we have earnings growth rate, operating profits and margins, interest rates, monetary policy, all positive. Mixed picture on fiscal policy and investor sentiment has been definitely positive. Monetary policy side, we see inflation is really the only negative, as it hasn't gotten down to the Fed target yet. Liquidity, employment, GDP growth, and interest rate policy all look positive. On the fiscal policy side, taxes are positive. We just went over the tariffs and immigration and deregulation being a positive. So sort of look at the pluses and minuses here. Clearly, much more green than anything else.
Which is great to see. But what are your recommendations for our clients?
Well, our recommendations actually don't change that much over time, right? Regardless of market conditions, we know we can't time the market. So do not try to time the market. And we saw that time in the market is much more important than market timing. Stick with your financial plan, like you mentioned, Marcia. There's going to be volatility, there's going to be ups and downs, and sticking with your plan is critical. Stress test it as needed. If people are concerned about maybe stocks running higher or lower than they have in the past, different averages of inflation, we can stress test that for you and help you get comfortable with where your plan is today. Maintain a disciplined investment approach. So at our investment committee, it's on every monthly meeting list. It says, we are not bullish, we are not bearish, we are process, meaning our process drives our investment philosophy and strategy. We are not trying to make calls on the market. That doesn't mean we'll never make changes to portfolios. We do make changes based on our strategic look at what markets are doing, but we're really not making tactical decisions very often. And we can't control the markets, but we can control our actions. So clients can rely on us providing a disciplined approach to investment strategy, investment process, and holistic financial planning. Again, these things are pretty locked in. We really believe that this is going to, these are our recommendations and aren't going to change over time.
I like that. I like that, Mark. Well, with that, thank you once again, Mark, for putting together this comprehensive presentation for us. And thank you, Affiance team and Affiance clients, for joining us tonight.
Thanks, Marcia. Thank you for walking through this with us. Thanks for your support, and all of the clients that joined us tonight. Thank you for being part of our presentation and part of our Affiance family. We appreciate it very much. If you do have questions, please feel free to call or email me or your advisor, and we'll try to answer them as best we can. Thank you.